Hello, everyone. Okay, so here are the solutions to the practice exam for the final on accounting. So we're going to go one by one. On number one, we have a corporation that is issuing 5 million 10-year 8% bonds at 102. Interest is payable annually. What is the journal entry to record the transaction at issuance on January 1st, 2021? So if we're going to issue bonds at 102, we can add the percent to that. So it's 5 million times 102%. We're going to get proceeds a little bit more than the face value. So if we get proceeds at a little bit more than face value, that means that we're selling it at a premium. Okay. So if we sell at a premium, what are we going to get? Well, first of all, the 5,100,000, those are the proceeds. That's the cash that you're getting. So right now, at this point, since we're getting 5.1, we can cross off C. C is wrong. We're not getting 5 million, we're getting 5.1. Then we know that the bonds are always credited for face value. Okay, so it's either, it cannot be B. We can cross off B because bonds always credited at face value, which is the 5 million. Okay, so we're gonna debit cash for 5.1, credit the bonds for 5 million, and the excess is the premium. Okay, we're short on the credit side. Premiums are credited. Okay, discounts are debited. So in this case, we have an excess. And here we go. D is the right answer. Okay. So we're gonna write D here. Okay, number two. Number two requires a little bit more work. In this case, we received proceeds of 188,000 on a 10-year 6% bond issued on January 1st, 2019. The face of the bond was 200. Okay, so we have a face of 200,000. That means that in order for us to get 188, we must have sold it at a discount. Okay, so 188 is the proceeds, it's the cash that we got. That means that we discounted these bonds, discount 12,000. Okay, so 200,000 minus 12,000, this is the cash proceeds. Okay, now this discount right here will be amortized using straight line. Okay, it tells you for this extent, straight line. And the bond is for 10 years. So we're going to do 12 divided by 10. That means 1,200 per year. Okay, 1,200 per year. So now we're going to have is with T. Discount on bonds payable account. Okay, that is going to begin, as we said, premiums, okay, are credited, discounts are debited. So it's going to have a debit balance of 12,000. But year after year, we're going to amortize 1,200. Now, if you issue the bond on January 2019, and later it says that the company decides to redeem the bonds, meaning we're going to pay our investors back. Okay, and that will happen at the beginning of 2021. So we have 2 years of amortization, 2019 and 2020. So we're going to have 1,200, 1,200. So what is the ending balance of the discount? Okay, so let's do it. 1,200 minus the 2 years of amortization. We have discount with an ending balance of 9,600. So the bond value, book value, on January 1st, 2021 will be 200,000, the face value, minus the discount. So the value will be extra zero here. Wait. Okay. 190 of 400. Okay, so this is the book value of the bonds. Now we are redeeming the bonds at, let's see, 101. That means that we're paying cash to redeem. We're paying 200,000. Let's look here. 200,000 times 101%. Okay, so we are paying 202,000, okay, for the bonds. So if our book value is 190 and we're paying more than the book value, that means that we're going to have a loss, guys. Okay, so it's either C or D. And what is the amount of the loss? C. All right, so your answer is C. Okay, that's your loss. Okay, let's just draw lines so we know where the problem is. Actually, wrong one. Okay, number 3. So we have a company that purchased the building by signing a long-term note payable, or in this case, it's a mortgage, okay, for 480,000. Monthly payments are 4,500. So bear in mind, this is monthly. So if it's monthly, you have to divide the interest by 12 because the interest is always, always, always stated at annual, okay? So we want to know the amount owed on the mortgage after the first payment. So we're gonna have an installment schedule, okay? Payment, interest, principal reduction, and carrying amount. So we're gonna have, does it say how long? It doesn't say how long the mortgage is, but we know that the payments are going to be 4,500 a month. Okay, so that's our payment. We're gonna start with actually this. We are going to start with a carrying amount of 480. That's the loan amount. Okay, what is the interest on that 480? Well, we have the 480 times 10%, and then we're gonna divide that by 12 because this is monthly. Okay, so we get 4,000. Guys, if you want to know the formulas, you can always click on the cell and then look it up here. Okay. Okay. So again, the principal amount times the interest, which is 10%, okay, divided by 12 because it's monthly. So out of the 4,500 that we're paying, 4,000 goes towards interest, and the remaining amount, which is 500 in this case, goes to the principal reduction. That means that the new principal will be 480 minus the 500, 479, 500. So the answer in this case is B. Okay, B. Next. In this case, we have New Corp who's issuing 2,000 shares at $10 per value share of, they're issuing the shares for $16. Okay, so we have a $6 increase, or will be additional paid in capital in this case. Okay, so to record this transaction, what are the credits? Well, we're issuing the stock. That means that we're getting cash, so cash will be the debit, right? And we're issuing the stock for 16. So it's 2,000 times 16. We're getting 32,000 in cash. The other side, the credits will have the common stock, and this will be a par value. Okay, so This is the 2,000 shares times $10 par value. And then we have the additional paid-in capital. We're going to call paid-in capital in excess of par common stock. Paid-in capital in excess of par common stock. So that will be the difference. Okay, the 32 minus the 20, the 12,000. So in this case, what do we have? It looked like, oh, by the way, it's not stated value, okay? Just careful. Stated value is similar to par value, but in this case, this is par, so this will be wrong. This is wrong because it's only 20,000. Okay, C is the right answer. Common stock and paid-in capital in excess of par. Right answer is C. All right, next. So we declare and paid 58,000 cash dividends on December 15th. If dividends in arrears prior to that date was 10,000, how much is left over for common stockholders? First, we have to figure out how much preferred stockholders should get, and then we have to add the 10,000 that's in arrears, but doesn't really matter. We have to make sure that the stock is cumulative. If it's not cumulative, whatever is in arrears, it wouldn't be anything on arrears, okay? So it is cumulative. It means that we owe them whatever we haven't paid in the back, in the past, okay? So it's $20 preferred, okay? $20 par value, paying 8% on the $20. Okay, so preferred stock, $20 par value, 8%. That will be 1.6 per share. Okay, and how many shares do we have outstanding? 7,500. Okay, shares. So how much do we owe them per year? 12,000. Okay, so dividend, yearly dividends. Let's call this yearly dividends. Okay, now let's add whatever we have in arrears. Okay, so how much do we owe them? 22. Okay, total owed to preferred. Okay, and then we have total paid, which is 58. This is total paid. That means that the difference between these two will go to common stockholders. So that is the 58 minus the 22, 36. Okay, to common stockholders. Okay, so the answer in this case is C. Next. Okay, so similar within the same line. So now we want to know what is total paid-in capital. So what is paid-in capital? So the paid-in capital section of the equity portion of the balance sheet. First, we have the capital stock, right? So we have the preferred, okay, preferred stock, and we have the common stock, okay, and then we have the additional paid-in capital. So we have paid-in capital in excess of par preferred stock, paid-in capital in excess of par common stock, and that would be the total paid in. Okay, so let's add all these numbers. We have 200,000. We have 9,750,000. And we have the excess, which is 30,000. And we have the common stock is 11,500. Okay, so let's add everything up. Looks like the answer is A. Okay. All right. Let's keep going. So what is the net cash provided by operating activities? Statement of cash flows. So we're going to start with net income. Net income is 200,000. And then depreciation expense has to be added back, okay, because that's a non-cash expense. So we have to add it back to net income. Dividends paid, we're going to ignore because that will be in the finance section of financing activities. Okay. Loss on the sale of land, that we have to add back, okay, because that's not a cash loss. I mean, yes, we lost money, book value with respect to book value, and with the difference between book value and the cash received was unfavorable. But in this case, this loss of 15,000 doesn't mean that we paid 15,000. So we have to add it back, okay? Loss on sale, something. So we're going to add it back. And then we have the decrease and increases in current assets and liabilities. So first we have a decrease in accounts receivable. If your account receivable went down, cash is also an asset. For the accounting equation to balance, you need to increase your cash account. So decrease in accounts receivable would mean that we have to get that money back. Okay, it's an increase in cash, 30,000. And the liability is the opposite. If your liability goes down in this case, then that means that cash also must have gone down. Otherwise, your accounting equation does not equal. Okay, so yeah, if you're paying your payables, that means that your money is coming out of your bank account, right? It's very logical. So decrease in accounts payable, this is a negative, okay, 45,000. So cash provided by operating activities. $260 looks like the answer is A. Okay, what is the net cash used in financing activities? So what do we have here? Treasury stock increased by 20,000. That means that you purchased your own stock. Okay, so purchase of treasury stock, that's an outflow of cash. Okay, retained earnings increase as a result of net income of 120 and cash dividends paid of 40. So out of these three numbers, the only number we need is the cash dividends. Okay, retained earnings increasing, we're going to see that reflected in the balance sheet. It's going to be a difference. But basically the number we need here is how much is the payments, dividend payments. Okay, so again, cash dividends paid, cash outflow. Okay, dividends paid. Another outflow of 40,000. So cash used for financing activities is 60. So in this case, the answer is D. Okay, so in 2019, that will be our base year. What is the percentage increase in sales from one year to another year? Okay, let's get the difference. Okay, so we have 2020, which is 875, minus the 700,000. That's our difference in the base year. We're going to use as the denominator, okay? 700,000. So in this case, it's 175 divided by 700,000, 25%. Okay, so don't get confused with 125. 125 will be double plus the 25% increase, okay? So it's 25, which is D. Okay. And so it's a fun one. We have an accounts receivable turnover of 10. Okay, and we know the turnover would equal the net credit sales. This account receivable right here. Sales over the average receivables. So what do we have? We have an average receivable of 900,000. So we can just solve for X. So 10 times 900,000 would equal net credit sales. Okay, so we're moving the receivables over to the other side as the multiplication phase. It's just plain algebra. So 10 times 900,000, that's your net credit sales. So in this case, the answer is C. Oh, wait, C, B. I'm missing a zero. B, B. There we go. Let's put the format it so we can see the zeros here. Let's put the no. 9 million. B. Okay, B. Okay, so in this case, La Roche company purchased. Now La Roche is an investor. Okay, purchasing 1,000 4% bond pays interest on January 1st. Okay, so the entry for receiving the interest on January 1st, 2022. Now you're receiving interest. Okay, that will be you're receiving cash, and because it doesn't really say, but if the calendar year, the fiscal year ended on December 31st, you are going to have an interest receivable in your books. Okay. It does. Oh yeah, it does say. Good thing that it says. It has to say. A Roche company has a calendar year end. That means that on December 31st, there was an entry, okay, where we claim an interest receivable of 40. Okay. And at the same time, we claim an interest revenue of 40. So now on January, which is the entry that they want here first, you're getting the cash and the receivable is going away. 40. Okay, so the correct entry will be A. Okay. Right, let's continue. Now, another investor, okay, Eglin Company owns 30% interest on Bosco Corporation. So 30% interest, that means that we're going to use the equity method. We have significant influence, okay, significant influence. So we're going to use the equity method. During the year, Bosco pays 10,000 in dividends and reports a net loss of 200,000. How will Eglin's company's investment in Bosco affect the company's net income? So the company meaning Eglin. Okay, so in that case, the payment of dividends, okay, that's not going to be dividend revenues. That will be, we're going to get cash and we're going to credit the investment account. So none of these are income statement accounts. These two are balance sheet accounts. This is not impacting in your net income. Now the 200,000 loss, that's a different story. Okay, because now you have, instead of revenues, you have a loss. Okay, loss on investment. Loss on investment for 30% of that value. Okay, so 200,000 because 30% is your ownership, right? Times 30%, 60,000. And that is going to decrease the investment. Okay, 60,000. So basically the only out of these four, the only account that touches the income statement is loss on investment. So you're gonna have a 60,000 decrease. In this case, C is your answer. Okay, 30%. All right. So an accountant has debited an asset for 1,200. Okay, let's just do our accounting equation here. Assets equals liabilities plus owner's equity. Okay. So if we debit an asset for 1,200, okay, and the asset will increase, and we're crediting a liability for 500, okay, the liability is also increasing. What can be done to complete this transaction? Okay, so we can go one by one. Nothing further, no, of course. We're sure, we're excited. We're missing 700 on this side or a decrease of 700 over here. Okay, so if we debit stockholders' equity, that is a decrease to equity. Okay, remember the normal balance is here. In order to increase these accounts, we need a credit. In order to increase these accounts, we need a debit. Okay, so if we debit stockholders' equity, this will be like, it will look like this. That would be wrong. We're gonna be oof. The equation is not balancing, so B is wrong. Debit another asset for 700. Oh, that's bad too. Okay, because that increases the asset. Then you have a lot more on the asset side, on the debit side than on the credit side. So that will be wrong too. Credit a different asset. Now, if I credit a different asset, my asset will decrease. Okay. And now I'm going to be balanced because I'm going to have 500 on both sides. So the correct answer is D. Okay, D. 14. First period of operations, this company purchased supplies costing 7,000. Okay. So let's do a T. See what's going on with supplies. So we're purchasing supplies for 7,000 is an asset, increases on the credit or debit side. At the end of the period, we count the supplies and we realize that we only have 1,900 on account, on the storage, okay, 1,900. That means that we must have used some supplies. Let's see how much. We used 5,100 worth of supplies. We need to credit the supplies by 5,100. So we're not going to debit supplies. We're going to credit supplies. So that gives it away that the right entry is C. And at the same time, we're going to be debiting the supplies expense. Okay. So yeah, correct answer is C. $15. The entry to close income summary to retain earnings includes, all right. So the first entry we're gonna have is we need to get rid of the revenues. Okay, so revenue has a credit balance. Now we have to debit the revenues for 70,000. And we are going to credit income summary. Okay, for 70,000. Now, with the expenses is the opposite. Okay, we're gonna have to debit the income summary. I'm gonna aggregate all the expenses. Okay, with 77,500. And here I'm gonna say expenses. We should list one by one, but I'm just gonna aggregate the number. So what is going on with the income summary? I'm just gonna copy this T. We have it formatted. Summary. Content. Okay, so let's post it. We have 70,000 on the credit side, and we have 77,500 on the debit side. If we want to close this out, now we have a balance of 7,500. So if we side, right? So 77 minus 70,000, okay, 7,500, okay, on the debit side. So we want to close this out. What do we have to do? We have to credit the income summary. So the entry will be a debit to retained earnings and a credit to income summary. Okay, so for 7,500. Let's see. Debit to revenue, no. Credit to expenses, no. Credit to income summary for 7,500. Yes. C is the right answer. Okay. C is the right answer. Now we have a credit sale of 3,600 made on July 15th. The terms are 2% discount if paid within 10 days or the entire amount if paid within 30 days. We have a return. So, okay. What amount is received as payment in full? Okay, so we made a sale. And let's just have another T here. Let's call it accounts receivable. So the credit sale is 3,600. We're going to have an increase in a receivable for 3,600. Now the customer is returning 200. So now we have a balance in our receivable of 3,400. Okay. So if they pay on July 24th, are they within the 10 days? They are. They are within the 10 days. So we're not going to get the full 3,400. We're going to get 3,400 minus the discount. Okay, so the discount will be 2%. Okay, so this is the discount. So the amount we're going to get is A. A. All right, next. LIFO. Okay, LIFO. What is the value of ending inventory? Okay, using LIFO. So we have all the purchases, basic account of merchandise inventory at the end of the month reveals that 250 units are still on hand. So if the first units, the last units that we bought were the first ones coming out, okay, that's it. So 150 out to 50 out, we have 250 with us. So we have 150 from this batch, and then we have another 100 from this batch because 100 went out already. Okay, so the last units that we're buying are the first units going out. But this question is asking how much, what is the value of what we have left? And so in that case, we're going to have 150 units that we purchased for 390. Okay, actually that 390 seems to be the entire value. Okay, yeah, that is not the price per unit. So let's figure out what the price per unit is. Okay, so that will be 390 divided by 150. Okay, we bought them for 2.6. So I did the cost divided by units. Cost per unit. Cost per unit. So the name tells you what to do, guys. Okay, you take the cost, you divide it by the units. That's what I did, and I got the 2.6, and that gives me 390. Okay, and then I need another 100 units. And in this case, from this batch, how much am I paying per unit? Cost per 200 units purchased, 2.92. Okay, so I am buying, I'm left with 100 units that I purchased at 2.92. Okay, well, I guess this is either rounding or see that plus this. Okay, 683. So it looks like the answer will be 8. Okay, 683. 150 from the last, the first purchases, okay, and 100 from the second one. All right. So two individuals at a retail store work together at the same cash register. My goodness. If cash is missing, they're gonna start blaming each other and you will never know who's at fault. So two people, one activity, that's establishment of responsibility. Okay. So you are violating the establishment of responsibility internal control measure. Okay. So in this case, the answer is A. So don't confuse segregation of duties. Segregation of duties, two activities, one person. Okay. That will be wrong. In this case, two people, one activity is the opposite. Okay. All right. Next. 19. So we have the company that uses percentage of receivables to record bad debt expense. The account receivable balance is 600,000. And we estimate that 4% of that number will be uncollectible. Okay, so 600,000 times 4% equals, let's get that number, and I'm missing a zero here. 600,000 times 4%, it's 2,400. Okay, so that is the total that we should show in our books and the allowance for doubtful accounts. So copy and paste. Okay, so this should be our balance, and this account is a contra asset account. It should end up with a credit balance. Okay, now we're being told that the allowance account has a credit balance already of 5,000. So for us to get from 5,000 to 24, we need a new credit of the difference, okay, of these two numbers. We need to credit 19,000. So looking at the entries here, it's either B or C, and we just said this is a credit to allowance for doubtful accounts. So clearly the answer is B. Okay, B. Okay, 20. Asked one. Depreciation. So whole company places a new asset into service and the cost of the asset was 120,000. This asset has a 5-year useful life, but it also has the 30,000 salvage value. Remember, we do not want to depreciate the salvage value. So what are we going to do? We're going to use the cost minus salvage value to get the depreciable amount. Okay. Cost, salvage value. Remember, salvage value, residual value is the same thing, okay? Cost minus salvage value, you get the depreciable amount. And 5 years useful life, we want to know how much per year we're going to be depreciating. Okay, this is the useful life. We take the 90,000, we divide it by 5, so it's 18,000 per year depreciation. Okay. So what is the depreciation expense? Okay, this is per year, but careful with the dates. Okay, it looks like this was purchased on October 1st, and this is asking, and you're lucky that they don't give you 18, but it's very likely I'll give you 18. Okay, so you have to read the dates. Okay, so what is the depreciation expense for 2021? So this is yearly, okay, and they bought it in October. You have October, November, and December. So we're gonna divide this by 12. So we're gonna get the monthly depreciation. Okay, and you have 3 months. Spell this correctly. Okay, so 3 months. So the total depreciation for the year will be 4,500. So in this case, the answer is A. All right. Okay, guys. Good luck on your finals.